Hello, welcome back. So, Amazon reported earnings as well yesterday, or actually a few hours ago, and the stock was up about 14%. So, they really did very well on their earnings report. And in this video, we're going to examine what happened with these and why the company stock price is actually that high. Whether it's actually a potentially interesting opportunity to buy, because Amazon has been a great company, of course, and has given us a better price lately. Yet it's still having a pretty high PE ratio and a price to free cash flow ratio, and it still may be a little bit of an expensive one to get. Now, we can take a little bit of a look at what happened during the earnings report. So Amazon jumps on revenue beat and rosy guidance for third quarter. Now, you will see here that Amazon shares climbed more than 13%, and even though the company had a loss of 20 cents in terms of their EPS, they still got better revenue, 121 billion versus 119 over here, which is an increase on what it was expected. Really, it was better than expected, and they actually did better on both Amazon Web Services and advertising, which is also interesting to see. The revenue actually grew 7%, which topped estimates. Most people, I would say, expected a decline here, myself included. They actually did better than I would expect. And Amazon, which is even better and more unexpected, frankly, they said they expect to post third quarter revenue between 125 billion and 130 billion. And that is a growth of 13%, 13 to 17%. And analysts were expecting around 126 billion. And it looks like they're going to be doing something near that, if not better, potentially. And that's still significant growth, especially after we're seeing the COVID era and also the lockdowns and the supply chains problems. And the company doing that well, even during this kind of market conditions, is actually very impressive here. And as they said, despite continued inflationary pressures, which is another important pressure here in fuel, energy, and transportation costs, they are still making progress and on the more controllable costs they referenced last quarter. Now, Amazon had saved its headcount by about 100,000 people here, cutting it down to 1.5 million, which is absolutely insane for an amount of employees. And they have been announcing some layoffs, hiring freezes, and things of that sort because of the potential economic uncertainty, the potential problems with the economy. Now, Amazon, and it's also an interesting thing to notice here, an important thing to notice, the fact that they actually posted a 3.9 billion impairment loss here on their Rivian investment. It's another consecutive loss, second quarter, I believe, consecutive loss on their Rivian investment, for which we have talked about in previous videos. A horrible investment here, a massively overvalued company, and they have plans, Rivian that is, 49%, about 50% in the second quarter. Terrible loss here for Amazon, but it's on the broader side, on the broader spectrum, it won't really affect the company that much. It's down. The total loss on the investment has been down about 11.5 billion, and because of this write-down, Amazon had an overall loss of 2 billion in this quarter. Now that's not horrible, of course, but it does have an effect on the Amazon's loss pretty much, yeah, it can affect the company for sure. Now, you will see here another interesting, very interesting actually topic. The fact that ad revenue for Amazon has climbed 18% in this period. Now, Facebook, in the meanwhile, has recorded a drop, and the same thing with Alphabet, which has advertising growth slowed to 12%, and YouTube showed a dramatic deceleration to 4.8% from 84% a year earlier. So why is this happening? Now, you need to bear in mind that Amazon's ad revenue is much different to Google's and to Facebook's, because Amazon's ad revenue is about sellers, is about the sellers themselves that actually want to sell their product through Amazon. They are advertising through Amazon itself, through their platform, and it's actually part of their operating expenses, the ad revenue that they are spending with Amazon. It's a completely different story when we're talking about Facebook and Alphabet, because Facebook and Alphabet do not really advertise on their behalf. So it's not like they're advertising their own products and they are getting a cut on these products that they're advertising, as Amazon does. Because again, remember, Amazon is getting ad spend for products that they sell on their platform. And so Facebook and Alphabet are actually advertising products that are selling off their platforms. And so this is a much different comparison here. And you shouldn't really be comparing these revenues to each other, because again, these are different business models. But it's still nice to see that Amazon is actually getting some extras on this one. It may actually, however, be suppressing the income of the suppliers themselves. and this could be a potential problem for the future, because now their sellers would have to actually potentially increase their prices in order to actually cut down on the expenses that they incurred because of this extra costs that they had to incur. So interesting, there's an interesting dynamic here, and it's important to understand the difference. Now, other things here, Amazon's cloud seems to be having some nice increase and growth here in terms of what they're doing. So sales at AWS jumped 33% from a year earlier. That's very impressive here. They still seem to be doing better. But operating income, which obviously includes the investment related loss, the impairment, shrank to 3.3 billion from 7.7 billion a year ago. Now, yeah, the Amazon business has been growing nicely, and they are doing better and better here. And it's important to also remember the fact that they have recorded this $1 billion loss on Rivian, so their investments may be having a little bit of a trouble here. Although overall, with the rest of the business doing significantly well, this may not be a horrible thing for the business. Now, the problem with Amazon is sitting at $122 before today, which it's going to climb at about 140. We obviously wanted to get it at a cheaper valuation. When we have talked about it in the past, Amazon used to be relatively expensive, and now, after this 14% increase, it's still going to be expensive, and more than that. And the problem is, you may be watching this number here, and you may be having the fear of missing out on a potential investment. But the thing is, this has already passed, and now we're talking at $140 potentially. And now we're going to have to look at the company from a different perspective, because what happened in the past stays in the past. Now, it's important that the company is doing better than expected, and it's doing well in all fronts, but we really don't want to be paying too much in order to get it. We want to be buying at a cheap price and reap the benefits through the years, and not just take a look at what is happening today and just make our decisions based on the current price action and the current news that the company lets investors know about. So what is the actual price potentially to pay for Amazon is an interesting thing to consider here. Now, our stock evaluation tool can help us with that and can give us an idea. And what I'm going to do for this examination, for this case, is I am going to go with very high revenue growth, just to see what happens if the company continues to grow at this insanely high pace at 28%, 26, 21 over here. And in fact, I'm going to go 18, 20, and 22 for these estimates. Now, I normally wouldn't do this, but I kind of want to prove a point. And explain that if the company actually continues at this rate, what kind of price it makes sense to pay today. And the net income margin, I'm still going to go with the high one, 5, 6, and 7, which is in between their highest ones over here. And the free cash flow that I'm going to be using is also going to be a high one, 90, not 901, 90, 100, and 110 is what I'm going to go for. I cannot type today. Okay. So the annual return is 13%, is what I typically want to be getting out of any single stock. And what comes out of this one? What happens if we get a revenue growth of 18%, 20%, and 22%, starting from 469 that the company did last year? So we hit calculate here, and you will see that with these estimates, even with these estimates, we are still in the red, and our highest ones with a revenue growth of 22%, let alone 18% over here, they are sitting at a current price of $116, much lower than the current price, which is actually not this. The current price is about 140, and so the company is very expensive for what it is. And even though I love their price action and I love what they are doing in terms of their growth, in terms of their business, people have looked to this stock so much that they have brought the price so high. It's becoming a very expensive proposition to own this one at this current level. The good thing about any single stock is that eventually you will be seeing some cracks, and the stock price could go down at some point. There are multiple cases in the future where the best companies have gone down significantly in terms of their stock price, and it has happened with Amazon as well. Amazon actually had a slump of almost 90% at some point in the past, and it's hard to believe, but it has happened. And they could have another important drop at some point, and this is where I would like to take advantage. And if that doesn't happen, I'm willing to wait or just try and grab another company, a better opportunity at a cheaper price. I really mind overpaying. I don't want to be overpaying for any single company, because when the hype dies down, then I'm left with having overpaid. And if when you do overpay, you are not gonna be reaping the rewards of your investment as much as you could have if you have bought a company for which you haven't overpaid. And I kind of want to avoid these hyped up companies, because hype eventually dies down, and again I could be left holding the bag potentially, and also have the significant disadvantage that now all my ratios are so high that it doesn't even make sense to keep holding. And it's a much different story holding a company that goes down and it's still significantly inexpensive and it's still doing significantly well in terms of financials. I'm much more willing to be buying that, and even having a little bit of a temporary loss. It's a much different story, and I'm much more willing to go with this one. So that's what I wanted to talk about in terms of Amazon. Amazing company. They're doing very well. They keep expanding, lots of capital expenditures. I'm sure they will keep doing well in the future, but I need to get a better valuation, and I just can't be going with $140 right now. It's very expensive, so I will be avoiding. But thanks for watching, and next up it's going to be more than likely Apple, which also reported earnings. Tons of work for me these days, and I'll see you in the next video, guys. In the meantime, take a look at the video that I made about Intel and its disaster in terms of its earnings report. Thanks for watching, and I'll see you soon. Bye bye.